Imagine two NRIs, they both buy the exact same stock on the exact same day and sell it for the exact same profit. One of them used an NRE account while the other used an NRO account. Does the NRE user pay less tax? If you said yes, then you are wrong. If you have been choosing your bank accounts based on saving tax on your investments, you might be following a myth that could cost you. Hi everyone, I'm Sagar Soman, a chartered accountant and cross-border wealth strategist. Over the last 20 years, I've advised NRIs on cross-border tax and compliance matters across multiple countries. My work focuses on NRI taxation, FEMA and DTA frameworks, and I'm currently working as an independent consultant with Belong to help you navigate these complexities. You're watching another episode of the Offshore Advantage, where we simplify global finance for the Indian diaspora. Today we are talking about the taxation of investments through NRO versus NRE versus FCNR. And before anyone jumps in, let me clarify one thing in plain language. NRE and NRO are bank account categories. FCNR is not a bank account for daily use. FCNRB is a foreign currency fixed deposit. So when people say NRO versus NRE versus FCNR for investments, what they usually mean is this: does routing money through NRO or NRE change the tax on investments? And separately, what is the tax treatment of interest on NRE fixed deposit and FCNRB deposits? Now let's start by correcting the most common myth I see in NRI circles. Many people genuinely believe this. If I invest using my NRE account, then the investment becomes tax free. That is incorrect. The Income Tax Act does not give you an exemption because you used a particular bank account. It gives you exemptions only when the Act specifically says so for a specific type of income. So, if you remember just one line from today, remember this: your taxability depends on the nature of income and the charging provisions of the Income Tax Act. It does not depend on whether you routed the money through NRO or NRE. Now, let me explain why this myth exists. Because there are real exemptions in the law and people overextend them. For example, interest on an NRE account is exempt under section 10 subsection 4 clause 2 subject to conditions. And when I say NRE interest, I mean interest on the NRE account including interest on NRE term deposits maintained under the NRE framework. This exemption exists because the section 10 subsection 4 clause 2 specifically provides it. It is not a blanket NRE makes everything tax free rule. And the condition that matters in real life is simple. You must be eligible to maintain an NRE account as a non-resident under the applicable FEMA and RBI deposit rules, and the account must be maintained accordingly. If the underlying eligibility changes, the tax outcome can change. Now, the second exemption people hear about is FCNR. Interest on an FCNRB deposit with a scheduled bank accepted in permitted foreign currency under RBI permissions is covered under section 10 subsection 15 clause 4 FA subject to conditions. Again, it's a targeted exemption for a targeted deposit category. It is not anything foreign is exempt. It is not any deposit abroad is exempt. It is specifically about FCNRB deposits of the kind the law is talking about. So the correct mental model is this: if you want to claim exemption, don't ask which account did I use. Ask which section makes the specific income exempt. Now let's bring this back to the confusion NRIs have about investments. People ask me this all the time. If I buy mutual funds using NRE money, will my gains be tax free? If I buy shares using NRE money, will my gains be tax free? If I invest using NRO, will my tax be higher? Let me answer it in the simplest possible way. If two NRIs buy the same investment on the same day at the same price, one uses funds from NRE, the other uses funds from NRO. And if both sell it on the same day at the same price, from an income tax perspective, what changes for the taxability of that capital gain? Nothing. The capital gain computation is the same. The head of income is the same. The applicable capital gains provisions are the same. The tax rate framework is also the same. Because the Income Tax Act taxes the income based on the nature of income and your residential status under the Income Tax Act. It does not ask which bank account did you use to pay for it. Now let me add one more precision line here. Withholding mechanics can vary in practice depending on the documentation. PAN availability, treaty documents, lower withholding certificates, and how the payer is set up. So yes, the withholding you see on your statements can differ, but it does not differ because you used NRE versus NRO for investments. It differs because withholding is documentation driven. Taxability is income driven. Now let's apply this to the most common investments NRI do in India, mutual funds. Whether you invest in mutual fund using funds from NRE or using funds from NRO, the taxation of gains is governed by the Income Tax Act. It depends on what type of fund it is, the holding period, and the applicable capital gains provisions. If there is capital gain, it is taxed as capital gains. If there is dividend income, it is taxed as per the applicable provisions in your hands. The account you use to buy the units does not change the character of the income. What the account can change is operationally where the money gets credited and how frictionless repatriation may be, depending on the repatriation basis of that investment and the FEMA rules around it. Now let's talk about equity shares. Same logic. If you buy listed shares, the taxability of capital gains is decided by the Income Tax Act. It depends on what you sold, the holding period, and the applicable provisions for capital gains. NRE does not make capital gains exempt. NRO does not make capital gains more taxable. The simple logic is that the tax follows the income, not the bank account. Now let's talk about real estate. This is where myths become expensive. Some people assume if I bought property using NRE funds, then the gain will be tax free. The answer is no. Capital gains on property are taxable based on the capital gain provisions. The original funding source does not make capital gains exempt. What an NRE funding trail can help with is FEMA and repatriation documentation. But even on repatriation, real estate has stricter FEMA conditions and limits compared to many other financial assets. So don't mix up these two things. Taxability is governed by the Income Tax Act, repatriation is governed by FEMA, and the restrictions can vary sharply by asset class, especially for property. Now let's address the second myth. Some people think if I invest through NRO, tax will be higher. That is also incorrect in the way people assume it. Tax is not higher because you used NRO. What can feel higher is the withholding and the friction. For non-residents, payers often deduct tax at source under Section 195, where the payment is chargeable to tax in India. So what you experience as higher tax is often just higher withholding, and withholding is not the same as final tax. Your final tax is computed when you file your return based on your total income and applicable provisions, including DTA relief where eligible and properly documented. So do not confuse cash flow deduction with final tax liability. Now, if there is one place where NRE and FCNR are genuinely different from NRO from a tax perspective, it is interest income on these deposits. Let's take NRO first. If you keep a rupee fixed deposit in NRO, the interest is taxable in India, and the bank is required to deduct TDS on that interest for a non-resident recipient. This is the default position. If you have obtained and submitted a valid lower or nil tax deduction certificate under Section 197, then withholding can be reduced accordingly. But absent that, the bank will withhold. Now compare that with NRE. Interest on the NRE account, including interest on NRE term deposits maintained under that NRE framework, is exempt under Section 10, subsection 4, clause 2, subject to conditions. And the key practical condition is eligibility. You must be eligible to maintain the NRE account as a non-resident under FEMA and RBI rules, and it must be maintained accordingly. So the exemption exists because the law explicitly provides it. It does not mean NRE makes other income tax free. Now let's talk about FCNR deposits. FCNR B is a foreign currency fixed deposit. Interest on an FCNR deposit with a scheduled bank accepted in permitted foreign currency under RBI permission is covered under Section 10, subsection 15, clause 4 FA, subject to conditions. Again, a specific exemption for a specific deposit category. So here is the correct way to think about it. If your question is my investment income tax free because I used NRE account? The answer is no. If your question is interest on NRE account and NRE term deposit exempt because the act says so? The answer is yes, subject to conditions. Similarly, if your question is interest on FCNR exempt because the act says so? The answer is yes, subject to conditions. Everything else depends on the Income Tax Act provisions that apply to that specific income stream. Now I want to address one more subtle confusion that creates a lot of bad advice. People say I invested through NRE, so my redemption proceeds are repatriable. Repatriation is not decided by one sentence like that. In many cases, the repatriation basis is determined at the entry stage. How the investment was acquired, how it was designated, what FEMA permissions apply, and how the investments were held. So it's not simply a casual choice like I'll just credit proceeds into NRE or NRO and that changes the nature. In practice, the flow is usually the other way. If an investment is held on a non repatriation basis, proceeds will flow to NRO by default. If it is held on a repatriation basis under the permitted framework, proceeds may be eligible for repatriation subject to FEMA conditions and bank process. And again, property is a category where restrictions and conditions are tighter. So keep this separation very clean. Taxability is not determined by NRE versus NRO. Repatriation is not determined by casual credit choice. Both are determined by the underlying legal framework. Now let me give you a simple reality check you can use in conversations. If someone tells you invest through NRE and you won't pay any tax in India, ask them one simple question: which section makes that specific income exempt? If they cannot answer, it is not law, it is marketing. The law gives a specific exemption to NRE interest. The law gives a specific exemption to FCNR interest. For everything else, you will be taxed as per the applicable provisions for that income stream.